Welcome to this presentation of the results of our stock-taking of SMEs in the COVID pandemic. When the crisis hit earlier this year, the Commission's Directorate General for the Internal Market, Industry, Entrepreneurship and SMEs and the OECD intensified their already very effective cooperation to help national governments navigate their way through the pandemic to support our SMEs, including the vital task of compiling critical information on policy measures and good practices. Today, the OECD and the European Commission join forces to provide you with an up-to-date overview of the situation concerning SMEs in the midst of the pandemic. This joint presentation highlights how the two organisations have coordinated their efforts so effectively to support national governments and their SMEs. I'm delighted to be joined now by Lamia Cowell-Cherui, the OECD's Director for Centre for Entrepreneurship, SMEs, Regions and Cities, and Christian Schreiber, Deputy EU SME Envoy and the European Commission's Director for SME Policy.
Thank you, Shona. Before COVID hit, the EU's SMEs were continuing on an extended recovery and expansion path they had entered some 10 years ago after the subprime crisis. And our latest 2019 figures show that for the EU27, the SME sector continued to expand, although at a moderate pace. For example, the number of SMEs in the non-financial business sector increased by 1.6%. Value added generated by SMEs grew by 3.6%, actually slightly faster than the 3.3% expansion of EU27 GDP, while in 2019, SME employment grew by 1.3%. However, in the midst of the current pandemic, these figures seem to be like something from a long-lost past. The preliminary estimates for 2020 for the EU27 are anything but good news. We estimate that the number of EU-based SMEs will decline by 2.5%, accompanied by a loss of 2.4 million SME-based jobs. And the aggregated value added of EU SMEs is expected to drop by 6%. To put this into context, within just a couple of months, the preliminary data suggests that COVID has erased the gains of a decade-long SME recovery. It was only in the last 1 to 2 years that in many member states, the SME sector had actually recovered to the size that it was at the time when the financial crisis hit in 2008-2009. And without the immediate action of policymakers on the national as well as regional levels, it could have been even worse. Obviously, the immediate impact on SMEs were of a financial nature. So the OECD's latest SME finance scoreboard has zoomed in on this particular subject and further highlights the difficulties. And I'm very happy here to have Lamia, my dear friend and counterpart in the OECD, to give us her update.
Good morning, ladies and gentlemen. It is my pleasure to be here today with our good friends and partner, Christian Schreiber, to present the latest findings from a special edition of the OECD SME Financing Scoreboard. This biennial publication provides data on bank lending, alternative finance instruments, and financing conditions, as well as information on policy initiatives to improve SME access to finance. And we do so for 48 countries, including OECD members and emerging economies, as well as most G20 economies. The edition that we are launching today was developed specifically to provide a critical and timely assessment of the impact of COVID-19 on small and medium-sized enterprises. No need to remind that this is a very timely moment to discuss the impact of COVID-19 on SMEs and entrepreneurs. Across many countries, especially in Europe, economies and societies are grappling with the brutal second wave of infections, while still adapting and dealing with the consequences and fallout from the first one that hit us last spring. The pandemic has had a profound impact on SMEs and entrepreneurs, especially on their liquidity. And we can expect the situation to be exacerbated by the second wave. Understanding these challenges now is critical. We cannot wait until after the crisis to address them, because by then it will be too late. At the OECD Center for Entrepreneurship, SMEs, Regions and Cities, we are working hard to bring as much evidence as possible to the table to help shape government responses across a range of policies. And one of the most important levers for SMEs is access to finance, which is the focus of my talk today. To help understand where we are today, it is useful to take stock of where we were prior to the crisis. Across many countries, we had been observing a slowdown in SME lending for a number of years. The median growth in outstanding SME loans, for an example, contracted by around 4% in the EU in 2019. This was happening against the backdrop of a relatively favorable SME financing environment. Look at this chart. It clearly shows that SMEs' interest rates, which were already at unprecedented lows, continued to fall in 2019 in almost 3/4 of the 44 countries covered by the study. The drops were particularly strong in emerging economies like Colombia, Mexico, and China, but they were also significant in the UK, in Finland, in Denmark, and Canada, for example. This means that overall SMEs could access funds quite easily, a trend that is confirmed by a number of surveys, including the EU SAFE survey, according to which business owners indicated that access to finance was less of an issue prior to the crisis. On the other hand, we also observed that the take-up of alternative financing instruments such as leasing, factoring, venture capital, and online alternative finance was growing before the pandemic. Although these instruments still represented only a relatively small share of overall SME financing, this was really good news. To take one example, venture capital. Venture capital investments that are featured in the graph expanded in the majority of countries over the year 2019, actually in 29 out of 40 countries under study, with Central and Eastern European countries such as Estonia, Poland, and the Slovak Republic seeing significant increases. This diversification represents an important and very positive development. We know that alternative financing is an important channel for innovative startups and SMEs. But not only. In fact, there is a diversity of alternative financing instruments that is less well known, and a number of these instruments are actually also very suitable for many established firms, including those operating in the more traditional manufacturing sector. And here I'm thinking about leasing and factoring, for instance. So to recap, pre-crisis, the overall picture was fairly positive. Then came COVID-19, and SMEs' revenues and profitability were hit extremely hard, creating severe liquidity shortages for many, many small firms. So at the OECD, we have been monitoring the impact of the crisis on SMEs since the beginning of the pandemic, and we did so across 132 countries. Our policy note on the impact of COVID-19 on SMEs indicates that 1/5 of micro and small firms were at risk of failure within 3 months at the onset of the crisis. Based on the results of more than 60 surveys from around the world, we know that in the absence of government support, many viable SMEs would have gone out of business very quickly. So to mitigate the impact, governments in the European Union and even beyond have risen to the challenge, offering support on an unprecedented scale. These were broadly related to employment, financing, payment, and more structural measures. The chart on the screen focuses on finance-related policy measures adopted by 55 countries, including from the developing world. Looking at the top half of the chart, we can see that many countries have strengthened their existing support for financing, for instance, through loan guarantees, grants, and direct lending. In fact, loan guarantees and direct loans were the most used instruments in the majority of countries. But also new measures were adopted by a number of countries, including equity and hybrid instruments. So what about the impact of these measures? Maybe too early to say, but one thing is sure. Evidence indicates that the liquidity relief measures were effective in maintaining and bolstering SMEs' access to credit. Bank lending held up in the first half of 2020 in many parts of the world, and we have seen that in many EU countries, volumes even increased to meet rising demand from small businesses. Fiscal support measures, combined with a further loosening of monetary policies, were also instrumental in this regard. In other words, the response from policymakers has made a real difference on the ground, and we should appreciate this. What is more a matter of concern is that the crisis appears to be having a profound impact on the availability of non-bank sources of finance, especially early-stage equity financing. And here there is a risk of backsliding on the recent progress made regarding the diversification of SME financing instruments. This is something we must avoid, especially because these are important instruments, and not only for the most innovative startups, but also for a larger set of small businesses operating in many different sectors. And in this regard, we welcome the recent developments at EU and national levels, which seek to channel support through a broader range of instruments, working with a diverse set of financing actors. As the second wave continues to unfurl in Europe and in other parts of the world, our report flags a number of issues for policymakers that I would like to highlight. One key concern is that the current liquidity crisis could lead to a solvency crisis for SMEs. What we're observing now is that many SMEs compensate declining revenues by taking on more debt, which is increasing their corporate leverage and risk overburdening them with more debt. This trend may limit SMEs' capacity to invest for the future, for future growth, and make them more vulnerable to future shocks and failure. The number of insolvencies and bankruptcies have been kept in check so far because of support mechanism, but it's clear that there will be limits to how long all of them can be used. And we can really expect bankruptcies to rise in 2021. So what can we do and should we do? Looking ahead, it will be crucial to continue to support SMEs, but in a way that does not impede a sustainable recovery. On the financing side, this means a greater use of instruments that do not increase leverage, such as subordinated or convertible loans or other hybrid instruments as well as equity. But also going forward, we need to go structural, and we need to start now. Support measures should aim to address long-standing structural issues by accelerating the uptake of digital technologies by SMEs, upskilling and reskilling their workforce, helping them transition to more sustainable and green business models, and supporting their participation and their integration to global value chains. Last but certainly not least, governments need to place greater importance on firm viability when they design new measures. But strengthening economic dynamism and new firm creation is equally important. Dear friends, as Winston Churchill famously said, never let a good crisis go to waste. In this spirit, we need to take the opportunity of this crisis to help SMEs build back better for the future. And you can count on the OECD to continue to track financing developments, flag new trends and issues, and build the evidence base to foster SME access to finance during the crisis and beyond. Thank you very much.
Thanks a lot, Lamia. So what's next? Predicting the future is even in normal times a tricky business, let alone in times of a raging worldwide pandemic. So our forecasts for 2021 have to be read with extreme caution. However, from these forecasts we now have for 2021, it seems that we can be hopeful for a recovery next year, albeit somewhat lopsided. We expect the turnover of businesses to bounce back much stronger than their employment levels in 2021. The number of SMEs, on the other hand, will remain at a lower level because of a rising number of insolvencies, which were held up temporarily by ad hoc policy measures in the first months of the crisis. All this, of course, rests on the expectation that 2021 will see some decisive progress in solving this massive public health crisis with the introduction of therapeutics and vaccines. And so recent good news about BioNTech, a European company supported under the Horizon 2020 program, gives us hope. Policy-wise, this means for DG GROW, as well as for the OECD, that it will be still all hands on deck for the foreseeable future when it comes to supporting national governments and SMEs. As regards the EU, last week the European Parliament and the European Council agreed on the new multi-annual financial framework, the MFF, to the tune of an almost 1.1 billion EU budget. In addition, the Next Generation EU fund of more than 700 billion euro was finalized. And this massive instrument powers a so-called Recovery and Resilience Facility, which is designed to coordinate an unprecedented effort by the EU to put Europe's economy and its SMEs back on a growth track. In fact, our aim is even higher than just supporting businesses getting out of the current slump. We want to go much further to ensure that this recovery is guided towards attaining our long-term strategic goals of sustainability, enhanced resilience, and fully reaping the benefits of the digital age. The Commission's SME strategy, which was adopted at the onset of the crisis in March 2020, has already fully incorporated this triple transition. It contains a comprehensive set of both new and well-proven policy instruments to support SMEs. Therefore, the current crisis has not made it necessary to completely overhaul the strategy as such. Apart, of course, some refinements, some major refocusing, and front-loading of specific measures. And we hope that the reinforced SME Envoy network will play a crucial role in directing and monitoring the effective implementation of these policies in support of the EU's almost 23 million SMEs.